Alright, so now let's see the journal entry to record the factory overhead. The entry to record the factory overhead would be as follows. We are going to debit the factory overhead and credit all the total of the things that represents the factory overhead. So we have material that's credited for $500, wages payable credited for $2,000, utilities payable for $900, and accumulated depreciation for $1,200. All of this would represent factory overhead incurred in production. And then we get the total of these credited values and we debit the factory overhead. Remember, factory overhead is part of your inventory cost, so that's part of your assets. So under assets here we have debited the factory overhead, which is like a specific part of our inventory, and then we credited material, we credited the accumulated depreciation, we credited the payables, the wages payable, and the utilities payable under liabilities. So allocating factory overhead and predetermined factory overhead rate. This concept is very similar to a lot of things that we've done in financial accounting that's based on estimates. Sometimes it's not a very good idea to wait up until we know the exact value. So we have to predetermine an estimate for how much overhead is expected to be incurred. So factory overhead is different from direct labor and direct material in that it is indirectly related to the jobs. Remember that we cannot really trace it directly to the job. In other words, factory overhead costs cannot be identified with or traced to specific jobs. So because of that, factory overhead costs are allocated to jobs. So we cannot identify it to a specific job, we just allocate the cost, the total cost that we have to the different jobs. The process by which factory overhead or other costs are assigned to a cost object, such as a job, is called cost allocation. So in the cost allocation, the factory overhead costs are allocated to jobs using a common measure related to each job. This measure, we usually call it the activity base. Sometimes we can call it the allocation base or activity driver. But I think in this textbook we're going to use the term activity base more often. So three common activity bases used to allocate factory overhead costs. It could be the direct labor hours, it could be the direct labor cost, and it could be the machine hours. So whenever we are given a problem, please pay attention to what is the activity base that we're going to allocate our overhead cost, or in other words, calculate our overhead rate. Is it the direct labor hours? Is it the machine hours? Is it the direct labor cost? And then we base our allocation based on whatever the activity base. So factory overhead costs are normally allocated or applied to jobs using a predetermined factory overhead rate. And again, how we calculate it? We get the estimated total factory overhead, and that's an estimate, and we divide it by estimated activity base. Both of these are estimates. So the predetermined overhead rate is computed using estimated amounts at the beginning of the period. If a company waited until all overhead costs were known at the end of the period, the allocated factory overhead would be accurate, but not timely. This is going to be very late. And that's why we have to do these kind of estimates. So let's see this example for our company here that we've been using, which is Legend Guitars. So assume that Legend Guitars estimates the total factory overhead cost as $50,000. Again, remember, that's an estimate. The actual could be more or less. But our estimate in this case is $50,000 for the entire year. And the activity base is 10,000 direct labor hours. So our activity base here is based on labor hours, and it's 10,000 direct labor hours. So the predetermined factory overhead rate would be the 50,000, which is our estimate for the factory overhead cost, divided by the 10,000 direct labor hours, which is also another estimate. So that would be $5 per direct labor hour. Many companies use a method for accumulating and allocating factory overhead costs called activity-based costing, or ABC, and we'll cover that briefly in a future chapter. So ABC costing uses a different overhead rate for each type of factory overhead activity, such as inspecting, moving, and machining. The ABC doesn't only use one activity based, but several activity based. So how we apply the factor overhead to jobs. Here we have job 71 and job 72. Okay, so we had 350 hours here, and in job 72 we had 500 hours. We calculated our rate to be $5. So we take the 350 multiplied by 5, and that will give us the factor overhead. Again, remember, this is an estimated amount. So we call that the applied factor overhead. Same thing here, the 2,500, it goes to the other job, job 72, which is basically calculated as the 500 hours multiplied by the rate, which is $5. So that's $2,500. We'll include that as the factor overhead. So let's assume that this is a completed job in this case here, and this is still in production. So if job 71, this is completed, and then this is calculated as part of the total job cost, where we have the direct material, direct labor, and the factor overhead. So using a factor overhead rate of $5 per direct labor hour, $42.50 of factor overhead is applied as follows. Remember, for job 71 we had 350 direct labor hours, $5 each, for a total of $17.50. For job 72 it's 500 hours, $5 each, for a total of $2,500. And then we add these two numbers, the $17.50 and the $2,500, for a total of $42.50. So the journal entry to apply factor overhead increases, or in other words, debits the work in process and decreases or credits the factor overhead. So the journal entry to apply overhead to job 71 and 72 would be as follows. We debit work in process and we credit the factor overhead. Remember, work in process is part of your inventory, so it's going to be debited. And the factor overhead here, we're going to reduce it because it has been already moved to the work in process, for a total of $42.50. In other words, to simplify it, we combine the number of hours, which is the 850, multiplied by the 5 hours, which is the factor overhead rate, and that would be the $42.50. So on the accounting equation, one more time, work in process is part of your inventory. The factor overhead is going to be credited. We're reducing it. So now we debited one asset and credited the other asset. So how we apply the factor overhead to work in process? Factor overhead is increased, or in other words, is debited for the actual overhead cost incurred. So this is at the very end, we're going to apply the actual value. The factor overhead is decreased or credited for the applied overhead. Depending on whether actual or overhead is greater or less than applied overhead, the factor overhead account will either have a debit or credit ending balance. So in our case here, we started with a 200 credit balance. And then in this case, we debited the factor overhead cost incurred by $4,400. That's the actual factor overhead. And then we reduced the factory overhead based on our estimate by crediting it. Notice that the amount of actual is more than the amount of the cost applied, or our estimate. So again, I'm sorry, I think I missed that. So we had a beginning balance of 200, and then we debited the factory overhead by 46. So now the balance is 44. Because we have a credit balance, we debit 46, so the remaining balance is a debit of 4,400. And then the factory overhead cost applied is 42.50. And that would leave us with a debit balance of 150. So keep in mind that the actual incurred was more than our estimate by about $350. And since we had a credit balance from the very beginning, that reduced the amount of the difference to 150. So in this case, we made an underestimate of $350, but the 200 credit balance helped us to reduce the underestimate by only 150. So we call the underestimated value we call it underapplied, If it was more like what we had before, we call it an over-applied balance. So one more time. If the applied overhead is less than the actual overhead incurred, the debit balance is called an under-applied factor overhead or under-absorbed factor overhead. In my own words, I call it an underestimate of the overhead. If the applied overhead is more than the actual overhead incurred, the credit balance is called an over-applied factor overhead or over-absorbed factor overhead. In other words, it's overestimate. Now let's dispose the factory overhead balance. We cannot keep it at the very end of the year. We're going to absorb it into or dispose it in the cost of goods sold. So during the year, the balance in the factory overhead account is carried forward and reported as a deferred debit or credit on the monthly interim balance sheet. Any balance in the factory overhead account should not be carried over the next year because it applies only to operation of the current year. So keep in mind, this over or under value, we're always going to close it at the end of the year. If the balance of factory overhead at the end of the year is relatively small, it is disposed by transferring it to the cost of goods sold account. Remember, the term for closing it is, we call it disposing it. So if the factory overhead is underapplied, remember that was an underestimate, so we are going to increase our cost of goods sold by debiting the cost of goods sold, and we reduce the factory overhead. If the opposite is the case, if the factory overhead is overapplied, then we debit the factory overhead and we credit the cost of goods sold. When we credit the cost of goods sold, we're actually reducing the amount of the cost of goods sold. In our case here, we had an underestimate. So the actual was more than our applied overhead. So the cost of goods sold has to be debited. We have to increase it by 150. And then we reduce the factory overhead by 150. Or in other words, we credit the factory overhead by 150. So the factory overhead is going to be credited by 150. The cost of goods sold as part of the stockholders' equity, because it's an expense account, is going to be debited for 150. So now let's see a job cost sheet and the work process controlling account. So remember, we had Job 71, which has been finalized. Job 72, we're still working on it. So the Job 71, the total job cost, including the beginning balance, direct material, labor, and factory overhead, turned out to be $10,250. We had 20 units, so if we divide $10,250 by the 20 units, the unit cost is $1512 or $512.50. In our work in process, we're going to reduce that balance because now it's been moved to finished goods. So we're going to credit the work in process by $10,250, and that would bring down our debit balance for the work in process to 21, which is the same value that we have for Job 72. So remember, we had a balance of 3,000. We added direct material, direct labor, factory overhead, but we completed Job 71, so we credit Job 71 by $10,250, and the remaining balance, the 21, this represents the remaining job that hasn't been finished yet. So let's apply that again on Legend Guitars. So during the period, the work in process is increased or debited by the three things that we just talked about: direct material, direct labor, and the applied factory overhead. Remember, the applied means like this is the one that we estimate. So let me go back here. These are the values that we were talking about: the direct material, direct labor, and the factory overhead. So during December, Job 71 was completed, and the product cost, which includes direct material, direct labor, and factory overhead, are totaled. This total is divided by the number of units produced to determine the cost per unit. And this is what I was doing with you. So we took the 10,250, we divided by 20 guitars, and that was $512.50. So after completion of Job 71, Job 71 is transferred from work in process to finished goods. So once finished goods now has been completed, we debit it because now we want to increase the finished goods inventory. So we debit finished goods inventory by $10,250, we reduce the amount of work in process, because remember, work in process is part of our inventory. So the work in process is going to be credited for the same value, 10,250. See, notice that both of them are under assets on the accounting equation. So the finished goods account is a controlling account for the subsidiary finished goods ledger or stock ledger. Each account in the finished goods ledger account contains cost data for the units manufactured, units sold, and the units on hand. So there were 400 Jazz series guitars on hand on December 1st, 2000, or year 8. During the month, 20 additional guitars were completed from job 71. We added that to them, and we sold 40. So in addition, the beginning inventory of 40 Jazz guitars were sold during the month. So if you look at the Jazz series guitars here, which is the finished goods ledger, we see that we had on December 1st 40 guitars. The unit cost is 500, so the total amount is 20,000. Multiply 40 by 500, so that's 20,000. And then we sold on December 9th the 40 units. So the cost would be reduced by the 20,000, which is our cost. Now the balance is 0. So these were shipped out. And then we manufactured, based on job order 71, 20 units. The total value is 10,250. So end of the month, or end of period, we have December 31st. We have 20 units left, 10,250. If we divide this value by the 20, that would give us the unit cost of $512.50. So during December, Legend Guitars sold 40 Jazz Series guitars for $850 each. Keep in mind, the cost is $500, the selling price is $850. Generating total sales of $34,000. So if we take the $850 multiplied by 40 guitars, that would be $34,000. So the cost per guitar sold was $500, or the total cost of $20,000. So remember, whenever we're making a sales transaction, 2 journal entries need to be recorded. The first one to record the sales, the other one to record the cost of goods sold. So let's start with the sales journal entry. We debit accounts receivable for $34,000. That's based on the selling price of $850, and then we credit sales for $34,000. That's a typical journal entry for sales that we should have learned in financial accounting 1A. So please remember that. So we debit accounts receivable, we credit sales. And then we need to calculate the cost of goods sold. The cost of goods sold in this case is $20,000, and then we credit finished goods, because now it's sold, for $20,000. So let's see the period costs. The period costs are used in generating revenue during the current period, but are not involved in the manufacturing process. Here we have selling expenses, administrative expenses. These are examples of period costs. So selling expenses are incurred in marketing and delivering the sold product to customers. Administrative expenses are incurred in managing the company, but are not related to the manufacturing or selling functions. So during December, Legend Guitars recorded the following selling and administrative expenses. And that's just a typical journal entry to record these period costs. So we debit sales salaries expense for $2,000. We debit office salaries expense for $1,500. The total of these are credited for $3,500, and that's under salaries payable. All right, so I'll skip this flow of manufacturing costs for Legend Guitars. You can, because everything we've done here, we've already done before. Just follow the transactions and see how each one of these has been recorded in the different accounts. So we have an account for material, we have an account for factory overhead, for wages payable, work in process, finished goods, and the cost of goods sold. And here we have the subsidiary material ledger, where we have different kind of wood, or the wood that's used, which is the maple, the glue, the sandpaper, and so on. So Legend Guitar's subsidiary ledger balances an income statement. That's how it's going to be presented. The balances of Legend Guitar materials work in process, and finished goods are supported by their subsidiary ledger. So the controlling accounts, we have material, work in process, and finished goods. These are their totals, but these are the balances and the total of related subsidiary ledgers. On the income statement, we have the sales, $34,000. Cost of goods sold, notice, it's $20,150. Where did we get this $150? This happened because of the underapplied factory overhead. Remember, when we have underapplied, we add it to the cost of goods sold by debiting cost of goods sold. If it's overapplied, we actually subtract it from the cost of goods sold. Or in other words, we credit the cost of goods sold. So in this case, since we have an underapplied factory overhead, we added it to the cost of goods sold. So our total now is $20,150, and that would give us a gross profit of $13,850. And then we record our period cost, the selling and administrative expenses. We have the sales salaries, we have the office salaries for a total of $3,500. We subtract that from the $13,850. We get an operating income of $10,350. Alright, so let's see a knowledge check activity again. Here we have an example for Livingstone Industries, a manufacturer of fine dishwasher, uses machine hours to calculate its predetermined overhead rate. Notice that they use the machine hours, not the labor hours, the machine hours. For the next year, its direct labor hours are estimated to be 24,000 and its machine hours are estimated to be 72,000 hours. So the estimated total factory overhead cost will be $1,260,000. What is the predetermined overhead rate? Since we have an estimated total factory overhead cost to be 1.260 or $1,260,000, we divide that by the machine hours, or estimated machine hours, which is 72,000. We don't use the 24 hours because they say here that they use the machine hours. So we take the 1,260,000 divided by 72,000, and the right answer would be $17.50. So just to explain that, the format to calculate the predetermined overhead rate is estimated total factory overhead cost divided by estimated activity base. So using machine hours, the predetermined overhead rate at Livingstone Industries is this value, which is $17.50. Alright, so let me stop here. In the next video, we're going to finalize the chapter and we're going to talk about the job order costing for services or for service businesses.